You know what the financial industry doesn't want you to figure out? That keeping 6-month expenses in a savings account is one of the most expensive mistakes you can make. Banks love it. Financial advisors recommend it. Everyone says it's the responsible thing to do. But here's the truth. For every year you follow that advice, you're potentially giving up tens of thousands of dollars in retirement wealth. And nobody's telling you this because everyone profits from your fear. My name is Matthew, and I spend way too much time thinking about why we've been taught to hoard cash like we're preparing for the apocalypse. If you're someone who's been told to save 6 months of expenses just in case, but you're watching that money sit there doing basically nothing while your retirement account stays empty, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, I need to say this up front. Emergency funds are important. I have one. You should have one. But somewhere along the way, we turned a reasonable safety net into a financial prison, and it's costing people their future. Here's the thing. The standard advice you hear everywhere is to save 3 to 6 month expenses in an emergency fund. Some advisors even push for 12 months. And on the surface, that sounds responsible, right? But let's actually do the math that nobody wants to show you. Let's say your monthly expenses are $4,000. That's pretty typical for a household in America. Following the 6-month rule, you'd need $24,000 sitting in savings. Okay, now let's say you're 30 years old and you're choosing between keeping that full $24,000 in a high-yield savings account at 4% or keeping just $12,000 in savings, 3 months of expenses, and investing the other $12,000 in a low-cost index fund. Over the next 35 years until you're 65, that $12,000 in the market, assuming a conservative 8% average annual return after inflation, grows to approximately $177,000. Meanwhile, that same $12,000 sitting in your savings account at 4%, it grows to about $67,000. That's a difference of $110,000 from a single decision, made once. But here's where it gets really interesting. Most people don't just make this decision once. They keep feeding that emergency fund month after month, year after year, because it feels safe. Let's say instead of investing that extra $12,000, you're also adding $200 per month to your emergency fund beyond what you actually need, because it just feels better to have more. That $200 per month over 35 years at 4% gives you about $169,000. The same $200 per month at 8% in the market, that's $413,000. Do you see what's happening here? The safety of oversaving is costing you $250,000, and that's a conservative scenario. Now you might be thinking, but Matthew, what if I lose my job? What if my car breaks down? What if there's a medical emergency? And look, those are legitimate concerns. This is exactly the psychological trap that keeps people stuck. Here's what most people don't realize. The point of an emergency fund isn't to cover every possible scenario that could ever happen in your entire life. The point is to cover the most likely emergencies while you're building wealth everywhere else. According to data from the Bureau of Labor Statistics, the median duration of unemployment in the United States is around 10 weeks. Not 6 months. Not a year. 10 weeks. Yes, some people are unemployed longer, but that's what unemployment benefits, severance packages, and side income are for. The question isn't whether emergencies happen. They absolutely do. The question is, what's the actual probability, and what's it costing you to overinsure against it? Let me give you an analogy. Imagine if I told you there was a 5% chance your house would get struck by lightning, so you should spend $100,000 on the most advanced lightning protection system ever created. You look at me like I'd lost my mind, right? Because yes, lightning strikes happen, but the probability doesn't justify that level of expense. That's exactly what's happening with oversized emergency funds. Here's the thing about financial advice that drives me crazy. It's almost always one size fits all, and it completely ignores your actual situation. If you're a dual-income household where both people have stable jobs in different industries, your risk of both losing income simultaneously is extremely low. You don't need the same emergency fund as a single-income household with one person working in a volatile industry. But nobody talks about this. The advice is always 6 months, minimum, No exceptions. Or here's another one. If you have a paid-off house and significant equity, you have access to a HELOC, a home equity line of credit. That's essentially a massive emergency fund you can tap if you really need it, and you're not paying anything unless you use it. But people will still keep $40,000 in cash just in case, while paying 6% on their mortgage. The math doesn't work. Look, I've seen this pattern over and over again. People don't actually have a financial problem. They have a psychology problem disguised as a financial problem. Let me tell you about what's really happening here. When you keep piling money into a savings account beyond what you rationally need, you're not being financially responsible. You're self-medicating anxiety with cash. And I get it. I really do. Money in the bank feels safe. Watching numbers go up in your checking account releases dopamine. It's tangible. It's secure. The stock market? That feels risky. That feels unpredictable. But here's what your brain isn't processing. Inflation is eating your savings every single day. Even at 4% interest, if inflation is running at 3%, you're only netting 1% real return. You're actively getting poorer in terms of purchasing power, but it feels safe because the number keeps going up. This is where it gets really interesting from a psychological perspective. What you're actually afraid of isn't running out of money in an emergency. What you're afraid of is the feeling of uncertainty. And so you're literally paying with hundreds of thousands of dollars to avoid feeling uncertain. That's an expensive emotion. All right, so what do we actually do about this? Because I'm not telling you to just completely drain your emergency fund and throw everything into Bitcoin or whatever. That would be ridiculous. Here's the framework I want you to think about. Step 1. Calculate your actual monthly expenses. Not what you think they are. Pull up your bank statements and add it up. Housing, utilities, food, insurance, debt payments, the essentials. Step 2. Assess your real risk. Are you single income or dual income? How stable is your industry? Do you have family you could move in with temporarily if everything went wrong? Be honest about your actual safety net beyond just cash. Step 3. Fund 3 months of expenses. Not 6, not 12, 3. For most people, this covers a vast majority of realistic scenarios when combined with unemployment benefits and temporary cost cutting. Step 4. Here's the key. Establish a tiered system. Keep that 3 months in a high-yield savings account. But then take the next $5,000 or $10,000 and put it in a brokerage account in something relatively stable, maybe a balanced index fund or even a short-term bond fund. It's not as liquid as cash, but you can access it within a few days if you really need it. And it's actually growing. Step 5. Everything beyond that goes into your retirement accounts and long-term investments. Max out your Roth IRA. Get your full 401k match. Build actual wealth. Now, I know some of you are still feeling uncomfortable with this. You're thinking, but what if the market crashes right when I need the money? Okay, valid concern. Here's the reality. If the market crashes so badly that your investments are worthless, your cash probably isn't going to help you much either, because we'd be in a complete economic collapse. At that point, we're all trading canned goods and learning to hunt. But let's stay in reality. Even in the 2008 financial crisis, the worst recession in modern history, if you had a 3-month emergency fund and kept making your regular investments, you would have been fine. In fact, you had bought stocks at massive discounts and made a fortune on the recovery. The people who got hurt in 2008 weren't the ones who had reasonable emergency funds and kept investing. They were the ones who had no emergency fund at all and had to sell their investments at the bottom to survive, or the ones who were so over-leveraged with debt that they couldn't weather any storm. Here's what I want you to understand. Being good with money isn't about eliminating all risk. That's impossible. Being good with money is about managing risk intelligently and understanding the cost of your decisions. Yes, having a large emergency fund reduces your short-term risk, but it dramatically increases your long-term risk of not having enough money in retirement. You're trading one form of security for another, and nobody's explaining that trade-off to you. Let me put it this way. Financial security isn't about having the biggest pile of cash sitting in your checking account. Financial security is about having systems, diversification, and growing wealth. It's about having money working for you in multiple places, some in cash for immediate needs, some in investments for long-term growth, some in skills and relationships that can generate income. Look, here's my challenge to you. Go calculate right now how much you have in your emergency fund. Then calculate 3 months of your bare minimum expenses, not your normal lifestyle, but what you'd spend if you really had to cut back. If your emergency fund is more than double that amount, you're probably oversaving and it's costing you. I'm not saying take all that excess money and do something crazy with it tomorrow, but start shifting it. This month, redirect some of that extra savings into your Roth IRA. Next month, increase your 401k contribution. Make it gradual if that helps you sleep at night. But make it happen. Because here's the thing that nobody wants to admit. The biggest financial risk most people face isn't a sudden emergency. It's getting to age 65 and realizing they don't have nearly enough saved for retirement because they spent 30 years being too safe with their money. The emergency fund lie isn't that you shouldn't have one. It's that more is always better. It's not. More is often worse. And the financial industry keeps pushing this narrative because banks make money when you keep cash in savings accounts, and because scared people don't ask hard questions. So yes, build your emergency fund. Absolutely. 3 months of expenses. Make it a priority. But then stop. Move on. Start building real wealth. Your 65-year-old self will thank you for having the courage to be strategic instead of just being scared. If this changed how you think about emergency funds, do me a favor and share this video with someone who needs to hear it. And if you haven't already, hit that subscribe button because we're going to keep having these conversations that the financial industry doesn't want you to hear. I'll see you in the next one.